Coming up on Market to Market. Choice prices turn to hamburger as the cattle industry takes it on the chin. The EPA proposes a plethora of changes to air and water pollution policy. And an old-fashioned competition helps harvest memories from the past. Those stories and market analysis with Mark Gold next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, October 2 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. After showing improvement for several months, key factors in the strengthening economy fell back on hard times. According to the Labor Department, only 142,000 jobs were created last month, well below what economists believe indicate a sign of healthy growth. Despite declining job numbers, the unemployment rate remained at 5.1% as fewer Americans looked for work. The drop was reflected in the Consumer Confidence Index, which showed only a moderate increase for last month. Oil giant Royal Dutch Shell decided to cease development on one of its newer Arctic Ocean leases. The news sent crude prices downward by 3% at the beginning of the week. Low job numbers, Shell's drilling plans, and disappointing earnings gave Wall Street quite the ride. By the time investors stepped onto the platform Friday, the market had settled on an up note. ExxonMobil stockholders shared a rocky week after losing a lawsuit in New Hampshire over groundwater contamination from MTBE. The petroleum product was used to combat wintertime air pollution issues, now handled largely by ethanol. The damages awarded were over $235 million, the largest in state history. The government agency responsible for what amounts to a ban on MTBE was the EPA. And this week, the federal agency continued its war on pollution, unveiling a flurry of policy updates. Appearing before the Senate Environmental and Public Works Committee this week, EPA officials said the current allowable discharge levels from manufacturing plants fail to protect public health, and a stricter air pollution policy is needed. They went on to tell the Senate panel that new smog standards would help improve the economy, protect the environment, and prevent thousands of asthma attacks. The proposed stricter rules were met with resistance from Committee Chair James Inhofe. The Oklahoma Republican countered that more stringent discharge limits would have little impact on the air we breathe and even less influence on the economy. The new smog plan came ahead of a court-ordered deadline on Thursday. Proposed regulations would also fulfill a long-delayed Obama campaign promise. Well praised by clean air supporters, any rule changes will likely set up another confrontation between the president and Republicans who are already angered by other green policy proposals. Electric power plants around the nation have been targeted by the EPA for polluting the nation's rivers and streams. This week, the federal agency laid out new standards for mercury, lead, and other heavy metals. The proposed rules are the first to set nationwide limits on air pollution from coal-fired steam electric generating facilities. The new rule is expected to keep 1.4 billion pounds of toxic metals out of U.S. waterways. EPA officials say most of the country's 1,080 coal-fired power plants already meet the new standards. However, 12% of those generating stations, located mostly in the South and Midwest, would need to make large investments in new equipment to bring their facilities up to code. According to the agency, more than 23,000 miles of streams and rivers across the country are polluted by toxic discharges from coal-fired power plants, as well as being the source for almost 30% of all toxic pollutants emitted from U.S. industrial facilities. Also this week, the EPA set new rules to reduce toxic air pollution from oil refineries by forcing operators to better monitor emissions. This includes language to require air monitors along fence lines, where output enters neighboring communities. And the implementation of new regulations for fracking were halted in their tracks this week. A judge agreed with opponents who argued the EPA lacked the authority to regulate the controversial method of pumping more oil and gas out of the ground. The new policy would have required petroleum companies to disclose the ingredients of the brew used to crack open oil and gas-bearing rocks. The injunction will allow pending litigation to take its course through the legal system, which will likely put the new rules on hold for years. As the annual rite of fall begins, massive machines harvesting huge swaths of nature's bounty march their way across flowing fields of grain. Many have watched with a smile as 16-row combines take just a few hours to pull corn from a field that would have taken months to harvest by hand. More than 75 years ago, thousands gathered to watch the best of the best move quickly down the row as bangboards thumped out a testament to hard work and perseverance. As times have changed, some have kept alive the memories tied to harvesting corn by hand. And as producer John Torpy and I found out last October, some things are better off handled the old-fashioned way. Paul Yeager explains.
In a scene resembling a Norman Rockwell painting, people from all over the country gathered in Iowa last fall for a competition rooted in hard work. Honors were bestowed on the best competitors, but the real prize was awarded to everyone, as spectators witnessed a chore from the past that helped shape the legacy of the American farm. Corn husking contests began in the 1920s. Agricultural pioneer Henry Wallace was concerned that the strong work ethic was eroding from Midwestern life. So he invited farmers to a field near Alleman, Iowa, to see who could husk the most corn in a single day. That inaugural competition attracted only 3 contestants, but the event quickly grew in popularity. By the end of the decade, corn husking was a burgeoning national sport, with no less than 9 states hosting competitions. Interest in the events grew steadily through the 1930s, and by the 40s, crowds numbering in the tens of thousands were on hand for the Super Bowl of corn husking contests, simply called the National. In 1940, Davenport, Iowa attracted the largest crowd for the Corn Husking National. 116,000 spectators, nearly twice the population of Davenport itself, gathered to watch Irvin Bauman of Illinois pick 46.6 bushels, almost 2 tons, to win the coveted prize. With the onset of World War II, corn husking contests came to an abrupt end, and by the time the weary troops returned, rural America was in the throes of dramatic change. The same industrial buildup that enabled the Allies to defeat the Axis of evil was making its presence known down on the farm. The result? Farmers did more work with fewer people. America shifted from an agrarian society to one forged by industry, and millions of people pulled up roots and moved to densely populated urban cities in a mass exodus from the heartland. Hoping to preserve the history of harvesting corn by hand, Dave Vandenboom brought the contest back to Iowa in 2011. And to remain true to the competition's heritage, the only other laborers in the field were draft horses.
Years and years ago, that's how corn husking began, was you had corn in the field, you needed to pick it. It was done by hand. It wasn't done by a $300,000 combine. It was done by hand and a team of horses or mules.
In October of 2014, the rolling hills near Iowa's historic Amana colonies hosted the National Corn Husking Championships. And 5,000 fans gathered to watch 140 competitors, the most in the history of the contest, try their hand with the husking hook. For some, it was a trip down memory lane. Others marveled at the labor-intensive method of harvesting, and some were just plain curious how such an event held a century ago drew thousands to the fields. While the objective is simple, to compete at the national level is not easy. Contestants try to husk the most corn during a specific amount of time, typically ranging anywhere from 10 to 30 minutes. In corn husking's heyday, however, the national lasted 80 minutes, and there were no breaks. Trailing behind the husker is the gleaner, who picks up corn missed or dropped by the competitor. For every pound of gleanings recovered, 3 pounds of corn is deducted from the total weight. The harvested corn is judged for cleanness and uniformity. Deductions are imposed for excess husks.
We weigh out 20 pounds of corn, and anything that has shucks left on it, that's a deduction from their score, because when they were doing this by hand, any corn shucks you had took up space in the corn bin.
And when the dust finally settled, Frank Hennepin of Illinois emerged as the 2014 National Corn Husking Champion. Not to be outdone, however, Market to Market's very own Mike Pearson donned the husking glove in the celebrity division.
It's tough. Makes me appreciate modern farm machinery, for sure. Surprisingly fun. For the work that's required, it's surprisingly fun.
Well, yeah, 77 minus your barrel weight.
Oh,
good luck.
that's what, 5 or 8?
17.
17 pounds? So I was 50 pounds. Oh, man. Well, thank you, guys.
Well, thank you.
Thank you.
Appreciate you coming out. And
Appreciate your help, guys. This is educational.
Mr. Pearson, who's with Market to Market. You can call him Mike if you want to, but
You can. Appreciate it. Thank you.
Next, the Market to Market report.
Grain markets were mixed this week as corn and soybeans were unable to break out of their slump, but the big story was in the livestock market. For the week, December wheat rose by only a nickel, while the nearby corn contract gained less than a penny. Reports of a good harvest and anticipations of next week's supply and demand report allowed prices to languish as the November soybean contract fell 15 cents for the week. December meal prices followed the trend, losing $7 per ton. In the softs, December cotton fell back by 50 cents per hundredweight. Over in the dairy parlor, October Class 3 milk futures gained 15 cents. In the livestock sector, it really was like deja vu all over again. The December cattle contract dropped more than $5.60, November feeders lost over $7 per hundred, and the October lean hog contract finally joined the party, falling 40 cents. In the currency markets, the U.S. dollar index lost nearly 0.5%. November crude traded higher after early week losses, gaining 34 cents. COMEX gold fell back $9 per ounce, and the Goldman Sachs Commodity Index lost more than 2 points to settle at 356.65. Here now to lend us his insight on these and other trends is one of our regular market analysts, Mark Gold. Mark, welcome back.
Nice to be back, Mike.
Well, and we are glad to have you. It was an eventful week all the way
Certainly was.
around. I want to start off with this wheat market. We're back up above $5. We put a nickel on this week. Are the lows in?
Yeah, I believe they are. I'm a little bit friendly on all the grains in here. Maybe not quite yet on corn and beans, but the wheat market's had a nice little bounce. We've got a few weather issues around the world. We've got a few planting issues around. So do I want to be bearish at $5 wheat heading into planting? No, I don't. I think if guys have sold wheat, they should be buying back some calls in here, keep the upside open. But long term, I'm friendly to the wheat, looking for some kind of a bounce in here. We still have big world carryouts. There's no question about it. We're 126 million metric tons, but the market already knows that. We've gone through the harvest. We made some lows. We bounced here, and the funds have been short the wheat, long the corn. Over the last week or so, we've seen them come out of a lot of those positions, and I'd like to see the funds get long some wheat here, push us maybe back to 560, 580.
Okay, so still some legs under.
I believe it can over the next several months, yeah.
Okay, so you're talking into the first quarter of 2016.
Yeah, beginning of next year, somewhere in there, we should see a nice rally. I'm hoping for anyway.
All right. Well, let's jump down into the corn market. We've got harvest going on. You talked to a lot of farmers. What have you been hearing yield-wise?
You know, it's the same situation we've been faced with all year. Where it's good, it's really good. And where it's bad, it's really bad. Now, are we going to meet the government expectations out here? Informa came out today on Friday and said that we're still looking at a big corn crop. And I believe that on whole, there's a fairly decent sized crop out there. It's hard to believe. In all the areas I've traveled around the country, I haven't seen corn that would say it's as good as the USDA is telling us and Informa is telling us. But these are the numbers that we have. And like I said, where it's good, it's really good. And even in some of the states where we thought we had some problems, in Illinois, in Indiana, there's certainly some very poor counties in those states. But there's also some pretty darn good yields out there. But one of the pluses is we're getting through this harvest very quickly. I can't remember harvest weather this good for as long as we've had it in the last 2 or 3 weeks.
We are getting it done, and that raises questions as guys are filling up the combine, they're filling up the trucks. Do you sell and look to re-own with an option? Do you put in storage? What's your strategy with corn here at harvest?
Well, it's pretty much the same on corn and beans. Right now, there's very little carry in the corn market. There's just about enough to pay your storage costs. So if you're going to put the corn in the bin, which a lot of guys are, and try to get some basis appreciation after the harvest, what I want farmers to do is look at doing a hedge to arrive contract out in July, capture that carry that's in the market. It's about 21 cents. Capture that carry. But now you've got the corn sold. You've got the basis hopefully going to come back sometime between now and July. But in the meantime, I would be re-owning it because you've got it sold. I'd re-own it with a call option. I don't want to be bearish down here at 360, 370, 380 corn. The harvest is going at a pretty good clip, particularly once we get past the 50% mark on the weekly numbers on harvest. I think that's the time to look to really buy some call options in here and try to keep some upside. And you can go out all the way to next September, a year from now, on a corn call spread and get $1 of upside for about 23 cents. I think that's really good value.
All right, now we had the USDA quarterly stocks report out on Wednesday. Yeah. Any surprises in there for the corn market?
Not so much for the corn market, no. It was pretty much as expected. Again, it wasn't friendly enough, and that's what we saw the funds starting to liquidate some of those positions, selling the corn and buying the wheat.
Okay.
So there was nothing particularly friendly out there in the corn market.
Okay. Next, I want to talk about soybeans, and I want to start, this was an interesting week. We saw beans make a run at $9 both on Wednesday and on Thursday, and that leads us right into our first question here from one of our Twitter followers. This is Brian in Colorado. He's curious, it seems as though buying momentum is coming back into the beans compared to prior weeks. Should we expect this to continue?
Well, the last 2 weeks, the function of the bean market has been as much about the bean oil market as anything else. It's taken a leadership role, which generally isn't a good sign for long-term strength in the grains. It may be a little bit different this year. We've had some dryness in India. The monsoons have been a fraction of what they normally are going to get. Strong demand for veg oils out of India and Malaysia. So that sector of the market looks okay. The problem is we've got the bean meal. Funds are still long a little bit of meal. We've got to get them out of that first, in my opinion. And we still have the harvest ahead of us. So is this the day and the time I want to be buying calls back? Not quite today, but literally Monday or a week from Monday, start looking at buying some. Maybe again on November 1st, buy some more. But long term, I have no interest in being short down here at these levels. So again, I believe, I hear a lot of doom and gloom about American agriculture out here. And maybe I'm the only one, but I think 2016 can be a good year for American farmers out here. We've had 13, 14, and 15 have been tough years, downward prices, puts have paid off very well over those times. But now, do I want to be bearish at 360, 370 corn and 850 beans? No, thank you. I'll let somebody else be bearish down there. But as far as storing the beans, I wouldn't be storing any beans.
Okay.
There's no carry. There's 8 cents from November to November. It's 8 cents. From November to July, it's 15 cents. There's no reason to store these beans. Sell them. If you're looking for basis appreciation, then capture whatever carries there. Do the hedge to arrive contract. But the fact of the matter is, whatever you're going to sell off the combine, in my opinion, you've got to buy call options to keep the upside open.
Okay. Do you buy calls at your cash sale price, or do you look a little out of the money?
You got to come out of the money.
Okay.
And I would do a call spread to cheapen it up a little bit. Do not be selling calls down here to pay for puts. To me, it would be a poor decision to make.
Yeah, no sense in being twice bearish.
No, absolutely not.
Well, now, you talked a little bit about the doom and gloom in American agriculture. Next, I want to move to this cattle complex where there is a feeling of doom and gloom as these prices continue to tumble down another $5 in the live cattle market this week. Mark, are we getting close to a bottom?
Maybe a temporary bottom.
Okay.
We generally make our lows the first Monday of the month. Monday will be the first Monday of this month. So it wouldn't surprise me if Monday, and the market didn't act bad. We had a nice little bounce on Friday. We've broken this market awful hard. We've had one $10 rally basically in the feeder cattle market, had about a $6, $7 rally in the fat cattle market. Then we made new lows again. Can we get a bounce in here? I believe we can, but we still have the whole cycle having shifted out here. And there's still an incredible amount of risk in my opinion. So on any rallies, if you haven't done so already, I mean, our guys have been taking money out of these put options. You know, months ago, we suggested buying a 225 put for $5 a hundred. And go, oh, I don't want to spend $5 for that. Well, we've been taking money out of these puts all the way down, and now we still have the puts on. But if you haven't done anything to this point, use some kind of rally. Hopefully we can get that in the next couple of weeks for whatever reason, and look at buying some puts because there's still a tremendous amount of risk on the table.
Now, as you're looking at buying puts, at trying to find some way to hedge your costs in here, on the live cattle side in particular, nearly everybody is below break even all the way out there. What's the best way for a producer to handle? It's tough for guys to justify hedging below break even.
That's why a put option is such a good vehicle, because you're not locking in that low price, you're protecting it. If the upside comes, you've got that upside open to you. If you go hedge futures here, you're going to be locking it in under that cost of production. If you get a rally, you got to pay the margin calls. If something really good happens to this cattle market, you're going to get scared out of those hedges, take the loss. The market's probably going to break after that. Don't get involved with that. Just spend. I know how hard it is to spend money on these puts, but when they pay off as frequently as they do over the course of time, this isn't you buy a put and hope it's right tomorrow. This is over 10 years. If you can follow a risk management plan consistently, you can be very effective with these options, both the puts and the calls.
Okay. Now let's move into the feeder cattle market. We're looking at a different set of scenarios there. We are looking at herd expansion. Do you think we're approaching the bottom as well in the feeder cattle market?
Well, again, I think we can see a bounce in here.
Okay.
Hopefully Monday, whatever low we made today, it'll hold and we can see another rally in here. The volatility in these markets is extreme. It's 3 and 4 cent ranges almost every day out here.
2 limit moves this week, correct?
Yes, and we saw a limit up, we saw a limit down.
Yeah.
So, it tells you, and generally markets will get more volatile on the lows. So we've had a lot of volatility here. Maybe this is a temporary low. But when I look at the long-term frame of the next year, 18 months, I still believe there's a lot of risk in this cattle market.
So now that is my next question. We saw a lot of high-dollar cows, bred heifers bought in this last year. Yeah. For those producers, put option still your best way, looking out that 18 months to 17 or 16?
Well, I think you can come in shorter on the time frame to protect the price because we'll break fastest up front than we will in the back. But the fact of the matter is, if you want to go out to, the late spring time frame on feeder cattle and fat cattle, that gets you through the next 6 months. And if we're going to go through more pain in this market, it's going to come, in my opinion, in the next 6 months. So you don't have to go out and pay the time value on an option for a year or a year and a half out. We try to match the options at top third to when we think we can get the most bang for our buck, and we think it's more in the next 6 months. It'll happen in that time frame.
Okay. Now, one of the factors in the livestock market, particularly the beef market, with this very strong dollar, it's been very easy and affordable to export beef from other countries. Where do you see the dollar staying here in the next 6 months?
There have been a lot of bulls in the dollar, and, certainly when we were down at 80, 82 cents, I thought we had some good upside potential in the market, and we got that. Now we're at a level that we've seen the dollar backing off a little bit from these highs. We saw the unemployment number. The dollar had a pretty significant break, came back a little bit. I'm not that bullish on the dollar, and that's one of the things that makes me a little bit friendlier to the grain market, is if we can do something contrarian out here and see the dollar break, then maybe we can see a little bit more grain export business, which would certainly be helpful.
You bet. Now, hog market, Mark, before we let you go, are we getting a little toppy in here, down this week after several up weeks? Where do you think we're headed next week?
You know, we've been saying as the cattle were going to come down, the hogs were going to rally with it. If we get the rally in the cattle, then we'll see the hogs set back a little bit. If the cattle continue to break, I think they're going to buy something against it. I guess it'll be the hogs, if anything. So we have to keep a close eye on that cattle market. That'll be the real direction finder for the hog market.
Okay, and looking at that upside on a bounce, all going to be relative to the cattle market?
I believe so, unless there's some new scare out there or something that really spooks the market.
Okay, avian influenza might be
absolutely
a black swan to sneak up on us this fall. Hopefully not.
Let's hope not.
Those bird producers. Well, Mark, it was a pleasure to have you here. 10
nice
seconds. Crude oil, up or down?
Long-term higher. Maybe a break in the meantime, but long-term higher.
All right. Well, with that, thank you so much for joining us this week. That wraps up this edition of Market to Market. But Mark and I will continue our discussion and answer some of your questions in the Market Plus segment available on our website. That's also the place where you'll find audio podcasts and streaming video of the program. Now, once you land on our homepage, look for information on the Market to Market Classroom. That's our exclusive service connecting teachers and students to our stories about the science, technology, and business of agriculture. Click on the link and take a look. And join us again next time when we'll look at the long-term forecast for the rural economy. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.